Hi, I'm James Robinson, and this week we're going to talk about Miller Industries, my stock pick of the week, and specifically Miller Industries as it relates to their dividends. So here you can see a chart of dividends from Miller Industries. They paid no dividends until about 2009. The dividends that they paid have gone up every year. They were flat last year, but they've gone up pretty dramatically from about 10 cents a share to about 70 cents a share. So the company pays a 2.15% dividend yield. Generally speaking, they manage to grow that every year. So solid company in terms of dividends. Not fantastic, but we're going to talk more about why they're not fantastic later and some observations about this company that you should be aware of as you're analyzing this company. So generally speaking, when I look at dividends, through four different prisms. I look at yield and growth. So how much return are we getting on our investment and how quickly is that return growing? I look at dividend safety through the context of the company's earnings. So what percentage of their earnings are they paying to us and how sustainable is that? Dividend safety in the context of cash flow, which is, you looked at the exact same prism, but instead of using earnings, we're using cash flow as the metric. And then dividend safety in the context of the company's current debt load. So for yield and growth, all is pretty good. The yield is 2.14%. The average yield for the S&P 500 is 1.92%, so they're outperforming the S&P 500 by about 10%. The average dividend growth over the last 5 years has been 4.8%. That's less than great. It's better than inflation, so that's good. But for the last year, it's been flat. So when we talk about dividends for this company, everything is not hunky-dory. A lot of times, companies that I'd suggest you buy, the dividends are great. This is a newer company. It's a smaller company, so there's a little more fluidity to these things. So if you're looking for companies that you simply want to buy because it's a great dividend company, I would not recommend this company. I'm recommending this company because of the totality, the fact that it's a cheap company, it's a stable company, that it has little debt, it does pay a dividend. It's all of these things together to make it an interesting company to me. But if you compare this to Altria, where the dividend is fantastic and is rising and is company established, and this company isn't that. Don't buy this company if you're looking just for dividends. But if you're looking more for the total picture, then this company does have merit. So dividend safety in the context of earnings. This company is great. The current payout ratio is 24.3%. So the average for the S&P 500 is 40%. So they could have a 50% increase in their dividend and still be about the S&P 500 average in terms of payout ratio. So that's really, really good. You can see here that earnings have grown for the last 5 years, and you can see that the dividend payout ratio has gone down. So that starts to become, the average payout ratio for the last 5 years is 37.9%. So that starts to be problematic. I start to wonder, why is this company not raising dividends as it's raising earnings? You're going to see in the next slide why. But long story short, this company has plenty of income to pay its dividends. That's not the problem. So dividend safety in the context of cash flow. This is where we start to understand maybe a little bit what's happening in this company. The dividend payout ratio of free cash flow is 39.7%. The S&P 500 is close to 50%, so we're good there. The dividend payout ratio over the last 5 years is 22%, and even that's a little bit cooking the books, and I'll explain why in a minute. So here's the situation. Cash flow from activities for this company has been relatively stable. In 2013, it was a little lower, but generally it's been pretty stable, about $20 a share. We'd like to see that number increasing. Capital expenditures for this company have been all over the map. $5 in 2014, $11 in 15, $25 in 16 and 17, and then back down to $13 in 2018. That, in my opinion, is why the company is not increasing their dividends. They are having to spend an awful lot of money on plants and equipment and other capital expenditures to fund their growth. Now, the good news is they're not taking on debt to do this. The good news is they are managing to continue to pay the dividend, but these capital expenditures are a real problem. And you remember I showed you that in a different video that the company finally had started to increase or turn around its cash and marketable securities. I think one of the reasons they've done that is they've held the dividend in line and they've gotten their capital expenditures more in line. I'm going to be watching this company very closely for its capital expenditures, and I'm hoping to continue to see numbers in this $13 to $15 range. If I see that, this company is going to take off in terms of value. It's going to raise its dividends. It's probably going to buy back some stock. It's going to pay off its debt, and it's going to be a fantastic investment. If this number goes back to $24, $25 a share next year, this company is something I'd probably dump and can just consider it a mistake. So free cash flow it was actually negative in 2016 and 17, but it's a get back to being positive in 2018. You can see that in 2016 and 17, cash flow to pay dividends, it used more than 100% of its net cash flow, positive cash flow to pay dividends. That's not sustainable. Even in 2018, it's only 95% of dividends. So what I want to see here is this number getting to make more sense, which I think it will. So dividend saving in the context of its current debt load. The company has virtually no debt, but the company has virtually no free cash flow after dividends. And so we can't sustain much of an increase in interest rates. In fact, this company starts being unable to support its dividends at, well, let's face it, probably unrealistic. At 15%, this company can't continue to pay its dividends because the interest is going to gobble it up. But if this company takes on a lot more debt or takes on any more debt, then the dividend starts to become suspect. If this company has a reduction in cash flow, the dividend becomes suspect. So again, when I told you not to buy this company's dividend play, I was being sincere. I understood enough about this company to believe that if I'm looking for cash flow for my retirement, there's better investments in this. I think this is a company that's undervalued, that's going to appreciate. I think this company's turning a corner in terms of its profitability and will reduce its negative cash flow through capital expenditures. But none of that's proven. And so there's a certain amount of risk here. This is an educated guess. But I think the downside is relatively small. I don't think this company's going to stop making money. I don't think the company's going to go from a 9 PE to a 7 PE or something. So I think we're not going to lose much. I'm just not sure how much we're going to make. I think we're going to do great, but not because of dividends.